Welcome to episode 33 of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hammond. Today, we're diving deep into some critical updates in the mortgage and real estate market that you need to know about. Let's kick things off with some breaking news. Canadian mortgage rates have hit a 17-month low amid recent Bank of Canada rate cuts. According to WOWA's Canada mortgage rate page on July 30th, the lowest mortgage rates are currently available. The Bank of Canada cut its benchmark rate on July 24th, marking its second reduction in 2 months. This move coincides with a drop in government bond yields, leading to the lowest fixed and variable mortgage rates in the past 17 months. Borrowers with insured mortgages, typically those with down payments under 20%, and those with uninsurable mortgages, such as homes above $1 million, can benefit from these rates. However, despite the low rates, the real estate market's response remains complex. Historical analysis by WOWA Leads shows that drops in mortgage rates from their peaks do not always lead to a booming real estate market. Currently, the Toronto and Vancouver housing markets are stagnant, while Montreal, Calgary, and Edmonton remain active. In Toronto, the sales to new listing ratio is at 35%, indicating a buyer's market, with inventory levels at their highest since 2010. Historical data reveals that similar periods of high unaffordability and rate cuts did not necessarily boost the market. For instance, from the third quarter of 1981 to the third quarter of 1983, despite the Bank of Canada rate dropping from 20.78% to 9.26%, the Canada Home Price Index fell by 14%, while inflation rose by 17%. Vancouver's home prices dropped nearly 40% during this period. Similarly, between the second quarter of 1990 and the first quarter of 1994, the Bank of Canada rate fell from 13.5% to 3.6%, yet home prices in Canada decreased by 8%, with inflation rising by 10%. The Greater Toronto Area saw a 28% drop in home prices from April 1989 to August 1993. From the first quarter of 1995 to the fourth quarter of 1996, despite a Bank of Canada rate cut from 8.2% to 3%, home prices declined by 4.5%, with inflation at 3%. Vancouver's home prices dropped 17% from August 1994 to October 1998. During the 2007-2008 global financial crisis, home prices decreased by 9% between the second quarter of 2008 and the first quarter of 2009. Even as the Bank of Canada rate fell from 4.25% to 0.25%. However, prices rebounded in 2009. WOWA Leads attributes these patterns to the lag effect of rate hikes and subsequent economic deterioration. Most Canadian mortgages are fixed rates, so the impact of rate hikes is felt primarily during renewals, pressuring some sellers to sell their properties. Additionally, Bank of Canada rate cuts usually signal slowing economic conditions, higher unemployment rates, and lower self-employed earnings, all contributing to lower home prices. The Canadian housing market's performance varies across provinces. Ontario has seen recent price declines, while Quebec and Alberta continue to experience steady growth. Based on historical trends, areas like Ontario, especially the Greater Toronto Area, may see price moderation, while Alberta and Quebec remain stable. The full impact of the current high rates on the housing market has yet to unfold. Now let's move on to another significant development. Canada has just launched 30-year mortgages for new builds. This new policy aims to reduce monthly payments and encourage new home construction, addressing some of the housing supply challenges Canada is currently facing. Starting August 1st, first-time homebuyers purchasing newly constructed homes will be eligible for 30-year mortgage amortizations, up from the current 25 years. This change is expected to lower monthly mortgage payments, making it easier for young Canadians to enter the housing market. According to the government's announcement, Canadians work hard to be able to afford a home. However, the high cost of mortgage payments are a barrier on the path to home ownership, especially for millennials and Generation Z. The government added, to break down these barriers and help more young Canadians buy a first home, Budget 2024 announced the federal government would allow up to 30-year amortizations for insured mortgages for first-time homebuyers purchasing new builds. This initiative is part of the Canadian Mortgage Charter, which also includes provisions to protect homeowners facing mortgage difficulties and aims to improve generational fairness in the housing market. The Charter includes initiatives such as allowing renters to build credit scores through on-time rent payments. The new policy builds upon existing programs like the tax-free First Home Savings Account, which has reportedly helped over 750,000 Canadians save for down payments more quickly. Chrystia Freeland, Deputy Prime Minister and Minister of Finance, said, "For every young Canadian who wants to own a home of their own, we want them to be able to qualify for a mortgage and afford their first home. One of the biggest hurdles to home ownership for younger Canadians is qualifying for a mortgage and affording the monthly payments. That is why, starting August 1st, first-time buyers of new builds will be able to reduce their monthly payments with up to 30-year mortgages. This is just one of the many new measures our government is taking to make the dream of home ownership a reality for younger Canadians." The Canadian housing market may be entering a period of stress despite recent interest rate cuts, a new report suggests. An analysis by WOWA Leads, which examined mortgage payments versus income over the past 50 years, revealed a concerning trend in housing affordability. The Bank of Canada recently cut its benchmark rate for the second time in 2 months, with the current best fixed and variable mortgage rates at their lowest in 17 months. However, the report indicates that historically, such rate drops have not always led to a boost in the real estate market. Mark Twain once said, "History does not repeat itself, but it often rhymes." While he was not specifically talking about interest rate cycles, many believe that rate cycles follow specific patterns that can help us forecast market behavior, the personal finance platform noted in the report. The study found that mortgage payments for a newly purchased average property in Canada currently consume nearly all of an average person's disposable income. This level of unaffordability has only been reached twice before, around 1981 and 1990. The report drew parallels to previous periods of high unaffordability, such as the early 1980s, early 1990s, mid-1990s, and the 2007-2008 global financial crisis. In these instances, significant rate cuts did not prevent home prices from falling. For example, between the third quarter of 1981 and the third quarter of 1983, the Bank of Canada rate dropped from a peak of 20.78% to 9.26%. Yet the home price index declined by 14%, with Vancouver seeing a nearly 40% drop in home prices. Similarly, from the second quarter of 1990 to the first quarter of 1994, the Bank of Canada rate fell from 13.5% to 3.6%. But home prices decreased by 8%, with Greater Toronto Area prices falling by 28%. The sales-to-new listing ratio in Toronto, one of Canada's least affordable markets, is currently at 35%, indicating a buyer's market. The city's housing inventory is close to 25,000, the highest level since 2010. The report attributed these price drops to two main factors: the lag effect of rate hikes and economic deterioration. In Canada, since most mortgages are fixed rates, the real impact of rate hikes is felt primarily during renewals, which often occur after rates have peaked, the report stated. Looking ahead, the analysis suggested that different regions of Canada may experience varying outcomes. While Ontario has seen a decline in home prices recently, Quebec and Alberta continue to experience steady price growth. WOWA said that Ontario, particularly the Greater Toronto Area, may see price moderation, while Alberta and Quebec might remain relatively stable. One thing is certain, we have not yet seen the full impact of high rates on the housing market, the report concluded. A coalition of Ontario developers has written to 3 levels of government to ask for a reduction in taxes on new housing, saying it will pass on those savings dollar for dollar to home buyers. The new group, called the Coalition Against New Home Taxes, or CANT, is composed of 18 developers who collectively plan to build 100,000 new housing units over the next 10 years. The coalition wants to see federal and provincial governments remove the harmonized sales tax on all new housing, as they have done for rental housing construction. It would also like the province and the City of Toronto to eliminate the land transfer tax on new construction homes. The coalition would also like to see municipalities reduce development charges to 2009 rates, adjusted for inflation. We came to the realization that something's got to change, and we started thinking about creative ways to bring government to the table, to have an honest conversation and find solutions together. Matt Young, president of Republic Developments, who was spearheading the coalition, said in an interview. And so we felt that one way to do that would be to sign a pledge that says, for every dollar of taxes cut, this group of developers would cut their prices dollar for dollar to ensure that savings are passed on to home buyers. The group includes Altera, Harlow Capital, and Stafford Developments, among others. In 2009, taxes accounted for about 12% of the cost of an average condominium in Toronto, the group said. Now, taxes account for about 29% for the same home. Development charges alone are up 1,200% over the past 15 years, they say. Now, because of higher interest rates, the system has broken, the coalition said in its letter sent Wednesday to the federal government, the province, and the city of Toronto. For years, all levels of government have raised revenue off the growing cost of housing. If left uncorrected, high taxes on new homes will put further strain on housing supply in the coming years. The letter warns of job losses in the home construction industry and a hurting economy should nothing change. To solve the affordability crisis today, your governments must take bold action to make homes cheaper to build and cheaper to buy, the coalition said. We will accept any accountability measures the government wants to implement in order to ensure that savings get passed on to Canadians and home buyers, Young said. His company, which is building or planning to build numerous condominiums in Toronto, has seen a marked slowdown in sales beginning last fall. Housing is unviable today, he said. You cannot sell it low enough to get sales and still make money, and if you cannot make money or cannot meet a certain margin, banks will not finance your projects, which means all projects for the most part are pretty much stalled. Ottawa and Ontario have taken numerous legislative steps to try to kickstart the construction of badly needed housing projects. A combination of soaring home prices over the past decade, especially during the pandemic, and a steep increase in interest rates has stalled many projects. Recently released data from the Canada Mortgage and Housing Corporation show housing starts across Ontario in June are down 44% compared to 1 year ago. Material and labor costs have also increased significantly in recent years. There is no shortage of people who want to buy homes, but there is a shortage of people who can afford the homes that are available, Young said. Municipalities across Ontario are not sold on the proposal from the developer group if it means reducing development charges. The province passed a law in 2022 that cut development charges developers had to pay municipalities for infrastructure such as roads, sewers, and water. The Association of Municipalities of Ontario estimated the changes would leave municipalities with a $10 billion hole over 10 years. The province later walked many of those changes back, but the association says they still represent a $2 billion hole over the same time frame. The reason that the development charges are going up is for precisely the reasons that the developers have outlined. All of these input costs are going up, said Lindsay Jones, the association's director of policy. The answer cannot just be cutting development charges without a new source of funding to fund infrastructure, because with that, you are not going to be able to get more houses built. Despite that difference, municipalities are encouraged to be at the table with developers in an effort to find a solution to put a dent in the housing affordability crisis, Jones said. It is really unique that everybody has the same conception of the problem and is committed to that same goal of achieving housing affordability. And that is an opportunity that we see that we can really kind of collectively take advantage of, she said. As we navigate the complexities of the current mortgage and real estate market, it's crucial to understand what's essential for agents and brokers to succeed. Today, we're focusing on some valuable insights shared by Meaghan Hastings, the principal broker at the Mortgage Coach in Toronto. Meaghan emphasizes the importance of maintaining a positive outlook and the right mindset, especially during challenging times marked by high interest rates and lower market volumes. She believes that success or failure is largely determined by one's own actions and the company they keep. According to Meaghan, brokers should surround themselves with proactive and motivated realtors and colleagues. Associating with individuals who are actively seeking new lead generation activities and keeping each other inspired can significantly impact one's business positively. On the contrary, being around those who constantly highlight the market's difficulties can dampen one's prospects. Meaghan's career journey underscores the importance of control over one's situation. She founded The Mortgage Coach in 2019 after a stint in the banking sector and a switch to the broker channel. Her aim was to create a positive and productive environment where agents could thrive. For Meaghan, establishing a robust culture within her brokerage was paramount. She sought to create a place that would always inspire growth, continuous learning, and positivity. This focus on culture has been a cornerstone of her brokerage's success, even in a market that has faced numerous challenges over the years. Meaghan's enthusiasm for the industry and her clients is evident. She shares that she approaches her work with the same drive and passion as she did on her first day. For her, the journey is ongoing, and she constantly looks forward to the next opportunity to grow and succeed. For new agents entering the market, Meaghan advises maintaining a positive outlook and equipping themselves with the necessary educational tools and knowledge. She stresses the importance of learning about various products and establishing connections with lenders. Networking, whether through social media or traditional in-person events, is also crucial. Meaghan's genuine love for her work and her proactive approach serve as an inspiration for new and seasoned agents alike. She highlights the importance of embracing all aspects of the job, including the challenges and troubleshooting involved in deals. So, whether you're a seasoned broker or just starting out, remember that maintaining a positive mindset, surrounding yourself with motivated individuals, and continuously seeking growth opportunities are key to thriving in the current market. That wraps up episode 33 of the Ontario Mortgage and Real Estate Insights podcast. Thank you for tuning in. Stay positive, stay informed, and we'll see you next time.